Hey everyone, welcome back to Corporate Decoder, the place where we crack open the corporate world, and today we're looking at T-Mobile, us a giant in the wireless industry, and their latest 8K filing. Did they just pull off a massive financial maneuver, or is something else brewing behind those impressive numbers? Stick around to find out. Before we dive in, if you want more of these unfiltered looks into company finances, make sure you hit that subscribe button. And hey, we've got a great community forming on Discord to discuss these findings further. So join us there, link in the description. Alright, so what we have here is a Form 8K, which is basically an announcement for any major events that shareholders should know about. This particular filing is a bit of a celebration, or at least that is how it is being presented. T-Mobile USA, a big part of T-Mobile is Incorporated, just closed a whopping $1.15 billion public offering for their 5.000% senior notes due 2036, and another $850 million for their 5.850% senior notes due 2056. That is a cool $2 billion in new debt financing. Now, why issue more debt? The filing says the money is expected to be used for refinancing existing debt on an ongoing basis or for other general corporate purposes. This is pretty standard talk for companies looking to manage their financial obligations. They're essentially swapping out older debts for newer ones, potentially at better interest rates, or just getting more cash flow flexibility. It's like rearranging your furniture to make the room flow better. Let's look at what they're offering. They have these 5.000% senior notes due in 2036 and 5.850% senior notes due in 2056. These are long-term commitments, meaning T-Mobile is locking in these interest rates for a substantial period. The fact that they're issuing these notes under an existing indenture system, which has been amended multiple times, shows a well-established process for debt management. This isn't a surprise move, but a continuation of their strategy. The notes are guaranteed on a senior unsecured basis, which means the company and some of its subsidiaries are promising to pay up if T-Mobile USA can't. It's like having a cosigner on a loan. This gives the investors more confidence. The company's common stock with a par value of basically nothing, $0.00001. Per share is traded on the Nasdaq Stock Market LLC under the ticker symbol TAMUS. This common stock represents ownership, but when a company like T-Mobile goes out to raise this kind of money, they're doing it through debt, not selling more ownership stakes. This guarantee part is important. It means that if T-Mobile USA, the subsidiary issuing the notes, runs into trouble, the parent company, T-Mobile US Inc., and other subsidiaries are on the hook. This spreads the risk and protects the note holders. It's a common practice to ensure that the debt is secure, even if one specific entity within a large corporation faces difficulties. Now, let's connect this to T-Mobile's bigger picture. T-Mobile is known for its aggressive strategies, often competing on price and offering attractive plans. Funding these operations, especially infrastructure upgrades and expanding their 5G network, requires a lot of capital. Issuing debt like this is a key way they finance their growth without diluting existing shareholders by issuing more stock. They've got a whole range of existing senior notes like the 3.550% notes due in 2029, the 3.700% notes due in 2032, and even some very long dated ones like the 6.250% senior notes due in 2069 and the 5.500% notes due March 2070. This new issuance adds to that already substantial debt load. We see here a variety of maturity dates and interest rates on their existing debt. This diversification in their debt structure helps them manage risk. The new notes with coupons of 5.000% and 5.850% fit within this existing pattern, though the 5.850% for the 2056 notes is on the higher side, reflecting current market conditions or perhaps the longer term of that debt. The legal documents and opinions attached, like the one from Fried, Frank, Harris, Shriver and Jacobson LLP, are standard for these kinds of transactions. They signify that the legal aspects have been thoroughly reviewed and everything is in order for the issuance. It's like the final stamp of approval from the lawyers, ensuring everything is by the book. It is also interesting to see the press releases mentioned, one announcing the proposed offering and another confirming the agreement to sell the notes. This shows a planned and executed transaction, not a surprise announcement. Companies usually try to get ahead of these announcements to manage market expectations. When we look at this filing, T-Mobile is essentially continuing its strategy of using debt to fund its operations and growth. They are a company that thrives on investment, pushing forward with network expansion and customer acquisition. This $2 billion debt raise is a significant sum, and it highlights their reliance on the credit markets. On one hand, This indicates confidence from investors in T-Mobile's ability to generate future cash flows to service this debt. They have a solid market position and a generally positive outlook in the telecom sector, especially with the continuing demand for 5G services. However, we also have to consider the increasing debt burden. While managing debt is crucial, piling it on can also present risks. If interest rates rise significantly or if their revenue growth falters, servicing this debt could become more challenging. The fixed interest rates offer some protection against rising rates, but the sheer volume of debt is something to monitor. Their strategy seems to be a high-growth, high-investment approach, funded significantly by debt. It is a calculated gamble that has largely paid off for them so far, allowing them to compete fiercely, but it is a path that always requires careful management and vigilance. Overall, this 8K filing shows T. Mobileus continuing its aggressive capital, raising strategy to fuel its growth and refine its debt structure. It's a sign of a company that's still very much in an expansionary phase, leveraging debt markets to achieve its ambitious goals. The key will be their continued ability to generate strong cash flows to comfortably manage this growing debt. Alright, that is our breakdown of T-Mobile US's latest filing. What is your take on this debt issuance and what it signals for the company's future? Do you see it as a smart financial move or a potential risk? If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate filings, and don't forget to check out the Discord community in the description. We'd love to have you join the conversation. Thanks for watching, see you next time.